Investing broadly is putting money to work for a period of a time in some sort of projects or undertaking in order to generate positive returns, profits that exceeds the amount of the initial investment. It is act of the allocating resources, usually capital, with the expectation of generating an income, profits or gains. One can invest in many types of enterprise, either directly or indirectly, such as using money to start a business, or instead, such as purchasing real estate in hope of generating rental income and reselling it later at a higher price. Investing different from saving in that the money used is put to work, meaning that there is a some implicit risk that the related projects may fail, resulting in a loss of money. Investing also differs from speculations in that with the later, the money is not put to work per se, but is betting on the short time term price fluctuations. Key understanding investing. Investing is to grow one's money more time. The expectations of the positive return in the form of incomes or price appreciations with strategic significance in this care promise of investing. This spectrum of assets in which one can investing risk and return go hand in hand. In investing, slow risk generally means low expected returns, while higher returns are usually means means accompanied by higher risk. At the low risk end of the spectrums are basic investments such as certificate of deposits, bond or fixed income instruments are higher up on the risk scales, while stock or equities are regarded as riskier. Commodities and derivatives are generally considered to be among the riskiest investments. On one can also invest in something particular such as land or real estate, or delicate items such as fine art and antiques. Risk and return expertise can vary widely within the same asset class. For example, a blue chip that trades on the New York Stock Exchange will have a very different risk return profile from a micro cap that trades on a small business. Trades on the small exchange. The return generated by an asset depends on the type of asset. For instance, many stocks pay quarterly dividends, whereas bonds generally pay interest every quarter. In many jurisdictions, different type of incomes are taxed. Are taxed at different rates. In addition to regular such as dividend or interest, price appreciation is an important component of return. Total return from an investment can thus be regarded as a sum of incomes and capital appreciations. Standard and Poor's estimates that since 1926, dividends have contributed nearly a third of total equity return for the S&P's 500, while capital gains have contributed two-thirds. Capital gains are therefore an important piece of investment. Stock. A buyer of a company's stocks become a fractional owner of that company's. Owners of company stocks are known as the shareholders and can participate in growth and success through appreciations in the stock price and regular dividends payout of the company's profits. Bonds. Bonds are debts or obligations of entities such as government, municipalities, and corporations. Buying a bond implies that you hold a share of an entity's debit and are entitled to receive periodic interest payment and the return of the bond's face values when it matures. Funds. Funds are pooled instruments managed by investment managers that enable investors to invest in stocks, bonds, preferred shares, commodities. Mutual funds do not trade on exchange are valued at the end of the trading day. ETFs trades on stock exchange and like stocks are valued consistently throughout the trading day. Mutual funds and ETFs can either passively trade indices such as the S&P 500 of the Dow Jones Industrial Average or can be activated managed funds.